You are watching Money King News, the channel where we break down the most important U.S. financial news simply, clearly, and without confusion. I'm Max Money Fox, your animated guide to money and the economy. Today we're talking about one of the most important issues facing the U.S. economy right now, jobs. More specifically, why job growth has slowed, why official data was delayed, and what this means for you, for the markets, and for the Federal Reserve's future decisions. Let's get started. What the ADP report showed. Let's begin with what we already know. Earlier this week, we received the ADP Employment Report, a major private report that tracks hiring in the U.S. private sector. The data showed that only about 22,000 new jobs were added in January. For comparison, economists were expecting roughly twice that number. This is a very weak figure for an economy as large as the United States. So what does this mean in simple terms? It means companies are being more cautious about hiring. They are not rushing to expand, open new positions, or grow their workforce. When businesses become cautious, there is usually a reason. It could be due to high costs, uncertainty about inflation, expensive loans, or fear of a possible economic slowdown. So weak job growth is not just a number on a chart, it is a signal about business confidence. Why official data was delayed. Normally, every month we receive an official jobs report from the Bureau of Labor Statistics, also known as the BLS. This report is extremely important. It is closely watched by investors, economists, banks, and the Federal Reserve. However, this time the report was delayed due to a partial government shutdown. When parts of the government stop operating, many statistics are not collected or released on time. This creates uncertainty. And in the economy, uncertainty is almost as bad news. When accurate data is missing, markets start guessing, investors become nervous, businesses delay decisions. So the delay of the official jobs report is not just a technical issue. It adds instability to the economic picture. Why job growth matters for everyday people. Now let's talk about why this actually affects you. There are three main reasons. First, wages. When companies are hiring aggressively, they compete for workers. That competition pushes wages higher, but when hiring slows, that competition weakens. This means wage growth may also slow down. If prices for groceries, rent, and gas remain high while wages grow more slowly, people feel squeezed financially. Second, consumer spending. People spend more when they feel secure in their jobs and income. If the job market weakens, people become more careful, save more, and spend less. And consumer spending makes up a huge part of the U.S. economy. When people spend less, businesses earn less, which can slow the economy even further. Third, overall confidence. If people see fewer job opportunities, they become more cautious. They invest less, take fewer risks, and borrow less money. But a growing economy depends on confidence. What this means for the Fed and interest rates. Now let's talk about the Federal Reserve, or the Fed. Their main goal is to control inflation while keeping the job market healthy. Right now, they are in a difficult position. On one hand, inflation is still above their target of 2%. On the other hand, the job market is starting to cool down. If the Fed cuts interest rates too quickly, inflation could rise again. But if they keep rates too high for too long, the job market could weaken even more. That is why slow job growth makes their decisions much more complicated. And this is why many analysts believe the Fed will not rush to cut interest rates anytime soon. How markets are reacting. Financial markets are very sensitive to this kind of news. When job data is weak or delayed, investors don't know how to properly evaluate the economy. This can lead to volatility in the stock market. Stocks may rise or fall depending on investor sentiment. Bonds also react because they are directly tied to interest rates, and that in turn affects mortgage rates and loans for everyday people. For example, if investors believe the economy is slowing, they may expect future rate cuts. But if the Fed is still worried about inflation, rates may stay high for longer. So right now, there is a lot of uncertainty in the markets. What this means for mortgages and loans. For people thinking about buying a home, this is a critical moment. If interest rates remain high, mortgage payments remain expensive. This makes it harder to buy a house, especially for young families. If rates eventually drop in the future, more people may be able to afford homes, but that is not guaranteed yet. That is why many potential buyers are simply waiting and watching the situation. If you found this helpful, like the video and subscribe to the channel